Good afternoon, ladies and gentlemen, and welcome to the Science and Sport Investor presentation for the final results for the full year ended 31st of December 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted any time via the Q&A tab situated in the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll receive notification when they're ready to review. I'd also like to remind you this presentation is being recorded. Before we begin, we'd like to submit the following poll. And I'd now like to hand you over to Stephen Moon, CEO, and Jane Simpson, CFO of Science and Sport PLC. Good afternoon.
Good afternoon, everyone. And thanks for attending today. We've got quite a big turnout, actually. This is the third time we've used Investor Meets Company, and we've got 3 times the turnover from our first presentation. We're going to spend around about 30 or 35 minutes talking you through our 2020 final results and giving a flavour for the year ahead. For people who attended our recent pre-close update, apologies, but you'll see 2 or 3 slides that you've seen before, but I'm very conscious we've got a lot of people here to see our presentation for the first time. So if you'll bear with me through those couple of 3 slides. So jumping in very quickly to the highlights for 2020. So we had a very good year. I mean, we're all acutely aware that the whole world was ravaged by the COVID-19 pandemic. Nevertheless, we saw it as an opportunity as a management team to really focus on strategy, focus on refining our business model, and getting some complexity out of the system, and we managed to do that. It's been our long-held view as a management team and indeed as a PLC board that this business, around about £50 million of revenue, reaches a tipping point of profitability and scale. We got very, very close to doing that in 2019. We actually did it last year, so we hit revenue of 50.4 million, which was in line with the previous year. Because of all the work we did on restructuring and focus on supply chain, we managed to move into profitability for the year. So 50.4 million of revenue in line with 2019, which we thought was a decent performance, given there was the horrible Q2 first lockdown and then more disruption later in the year. And then for the first time, the business moved into an EBITDA profit of 1.1 million. And it's worth noting that we absorbed one-off costs related to COVID of around about 300,000 in that number. So underlying EBITDA around about 1.4. Key things that happened in 2020 that drove the performance were very strong shift to online. So anyone who's been an investor in the business for a while knows that we've been investing heavily in online or in markets around the world, and that really started to kick in. So now half the business is online. And then significant changes in supply chain, a new protein line, new supply chain team, some very healthy purchasing gains, operational efficiencies. That, together with the shift to online, enabled us to put 5 percentage points on the gross margin for the year. And indeed, that accelerated through the second half. During the second half, the gross margin was 50% throughout the whole second half. So in reality, a 6-point move on gross. And we got a very strong balance sheet. We raised money last April when the pandemic hit the world. We thought, for reasons of flexibility, nobody knew what would happen next. We raised 4.2 million net, and we stated at the time that it was to give us some stability through COVID. But very importantly, we stated that we could use it to accelerate coming out of COVID, and again, we'll touch on that more than once during today. We feel we're in a position to accelerate. The business generated operating cash last year. again, that's another milestone in its development. And again, we see that as a trend that is now going to continue at an operating level. We'll be generating cash. So we thought that was a good solid year from the business, but more importantly, we think that it really set the table for this year and the next couple of years after that. So if we look at current trading, as a management team, we said that this quarter last year was a non-COVID quarter. We only really felt the sales effect in the last week of the quarter. So we felt this year, we were in lockdown number 3, but we felt that if we could hold revenue level this year, so a COVID quarter holding level with last year's non-COVID quarter, that would be a good performance. So far, so good. January and February were in line. Gross margin improved again. We made further progress in gross margin during that period, January and February, and March is performing very well for us at all lines within the P&L. So we think we can achieve our objective Q1, matching or possibly slightly edging ahead of last year's Q1. Now that brings us to Q2. Q2, we took a horrendous hit last year. April, we were 70% down in retail, etc., etc. So we think with our momentum that started in the second half of last year, which has carried into Q1, we think that if we can carry that momentum now into Q2, we've got a good fighting chance of starting to get ahead on the year and seeing some proper growth go into place. We mentioned in our pre-close that during Q4 of last year, our online business grew at 65% year on year, and that number has continued. So we've, again, for January and February, we've seen online growth hit 65% versus the same period last year. And March, as we're bringing in more refinements to our marketing mix and new technologies starting to have a positive benefit, again, we're driving that momentum on. And now the online, the mix of online sales is now 54%. So 50% last year. Online as part of the business at the end of February is 54. It's edging up again in March. We're seeing in our international retail, we started to see in Q4 good positive signs of recovery. And again, we're seeing that in the first quarter of the year, and we're particularly seeing it this month. So as some of the Middle Eastern countries open up again, as our European distributors start to work with COVID and work with Brexit, we're seeing good performances across the spectrum in international. So we are seeing a strong recovery. And then, as mentioned a couple of minutes ago, channel mix, more supply chain benefits flowing through. The gross margin in Q1 of this year is again improving. We're continuing to make progress in gross margin. So all the signs are good. Getting to the end of Q1, all the signs are good. We're feeling pretty positive about the year. If I look at the business operationally, some of you have seen this slide before, but I'll just put it up for the for our guests who are here for the first time. We feel we've got a proven growth flywheel for this business. It all starts with science-led innovation, and each year we try and derive 25% of our growth from brand new products. We invest in brand, and we've got two of the most premium sports nutrition brands in the world, and that's measurable, and I'll come to that later. That's measurable, not an opinion. As we become more online, world-class customer experience counts more, so that's a key driver for us. Clearly, global online scale is something that we're pursuing hard, and online for us means both our own website and dealing with big marketplace platforms like Amazon and Tmall. And then finally, efficient supply chain. So we feel if we can get that circle right, we'll drive the business on, and that's what you've seen. We underpin that with a very healthily profitable retail business. For all the travails of retail around the world, as people shift online and retail stores get closed down with the pandemic, our retail business is fundamentally a very important part of our strategy. it's never going to grow at the level online grows, but it's going to steadily grow over the next 3 or 4 years and be very, very profitable while it's growing. So always part of we look upon retail as the channel that pays the bills for the growth in online. And then technology is an area we've invested heavily in over the winter. We've recruited a very good chief technology officer, and she's gone on to recruit a very good team around her. We've invested heavily in technology, particularly on our own e-commerce platform and at the back end in supply chain on areas such as warehouse management. So that's the flywheel, and I'll quickly walk around that. So innovation for us last year delivered 2.2 million. So 4% of sales came from brand new products. Notable things: we converted the whole PhD powder range into fully recyclable packs, and that's probably going to save around about 1 million packs going to landfill this year. A decent stream of vegan, bar and smart cake innovation from PhD during the year. And in Science in Sport, we launched the world's first endurance nutrition product specifically for indoor exercise. And as you can imagine, that's gone very well during lockdown. We've got an extremely strong pipeline for this year, to the point that we've got major launches every single Tuesday throughout March. So we've got a huge swathe of innovation in H1, PhD diet plant. Coming in May, we've got Science in Sports, second generation beta fuel. We're currently launching an extensive range of clear protein products for PhD. And then probably around about the half year, PhD will launch into the nootropic category. So cognitive health, sleep products. So we're very excited about innovation for this year. We've upped our internal target. Rather than 25% of growth coming from innovation this year, we are targeting 30%. The second leg of the flywheel, we've got 2 brands in extremely good health. We bought PhD a couple of years ago, and it was a sort of middle of the pack brand in terms of awareness and conversion and usage. And we've invested using the same model we use with Science in Sport. The most recent figures show that we're number 3 in the category. So number 1 is myprotein.com, owned by the Hut Group. So the world's biggest player in protein. They're number 1. Number 2 is the Grenade protein bar business, but we're now very, very close to Grenade. So we very quickly moved PhD from mid-pack right up into the leading pack, and it's our internal ambition to overtake Grenade this year. That's on awareness, but when it comes to attributes, quality, taste, trust, innovation, attractive packaging, we sweep the board there. So PhD on 12 brand attributes is seen as a leader. We've got a very engaged consumer. We've got a consumer that buys more products monthly than consumers of other brands. And we've got a consumer that spends a little bit more each month than consumers of other brands. So we've got a nice premium brand with a high spending and quite open-minded consumer when it comes to innovation. Science in Sport. We are number 2 in brand awareness, but in effect we're number 1. Number 1 in terms of awareness is MyProtein. Everyone's heard of MyProtein, but endurance athletes don't use a lot of their products. So when pure endurance brands are thought of, Science in Sport is number 1. We've got the strongest conversion regardless of who it is, including MyProtein. And again, in the 12 attributes, brand attributes, we lead in 11 of the 12. So again, very high quality, and again, we've got the most engaged consumer who will shop more frequently, spend a little bit more. So both brands are in rude health, and we're going to keep investing in them. Global online scale we've mentioned. So we have we've invested a lot in our Magento-based platform, and we've now got a platform that can roll out new websites very quickly. So we tomorrow actually we launch Science in Sport Japan, and we launch PhD Japan. At the beginning of April, we launch South Korea for PhD, and we launch for SIS. And then very rapidly, you're going to see sites go up in France, the Netherlands, and Russia and other Eastern European markets. And we've only quite recently launched PhD in Italy and Germany. So we've now got a platform that rolls out rapidly. We've strengthened our digital marketing talent. So we've got some very talented people who have joined the business. And on trading talent, we've had some very good commercial people join us, including people with proven experience in Asian markets. So we're not going into Japan. We're not going into Japan and South Korea and having to guess what we need to do. We've got a guy running the business who absolutely knows what to do. And then finally, we've invested in technology. Probably the biggest investment is in a customer data platform, so that we can understand a lot more about the customer and apply that to their shopping experience in real time. So again, as the year unfolds, we think that our already effective e-commerce business will become more effective. And along the bottom, you can see how e-commerce has grown as a share of the business from 32% to 54% by the end of February, probably above that number right now. So that's global online scale. Breaking it down into two halves, our own websites last year grew 29%. Even though Science in Sport in particular was very badly hit in the first lockdown, it recovered quickly, and indeed we exited the year with our own websites flying. And if you look down the metrics on the right, everything is positive. So revenue was up, traffic was up, orders were up, average order value, conversion stayed around the same, and that's not unexpected given the amount of extra traffic we drove. Average selling price was up, units per basket was up, and you can see we pretty much doubled the size of our database. So we feel that we survived COVID pretty well, and then very quickly got into strong growth, which went throughout Q4 and then all the way into Q1. So our own business is in good health. Our Amazon business grew 52% last year. We at this time last year we welcomed a guy to the business who was very experienced in Amazon, and we've got another woman who works in the USA who looks after our USA business on Amazon. So between the pair of them, they've driven 52% growth. A call out below, it's accelerating. So if you look at the USA, but to the end of February, January and February, Amazon USA grew 88% year on year. So last year's 52% is picking up. We're gaining momentum. Again, all the right measures were well up, 45% more traffic, conversion, a very, very high conversion number, moved up, and we moved average selling price up. So we see a lot more growth opportunities to come from Amazon this year. We're a big player in sports nutrition in Amazon in the UK when you combine both brands, and that scale's helping us. You can see the USA growth. And towards the end of last year, we launched Amazon stores in Germany and Italy, and now Spain, and they're starting to gain some traction. So I disregard the urban myth that Amazon gets older suppliers and squeezes them to death. We find it a strongly growing and very profitable business. So we're pleased with the Amazon business. In retail, you'd expect me to say this. Retail was massively hit by COVID last year, as you would expect. If the stores are closed, that's it. So overall, retail was down 22%. But as said earlier, it's a very, very profitable channel, so we're going to stick with it. In the UK, we were down 26% last year, but this year we're seeing more opportunities in grocers, particularly grocers with an online offering. Even in the last month, we've gained 1,500 convenience outlets, so garage forecourts, that kind of thing. We see that as an opportunity, and we see some of the big discounters as being a source of very profitable growth. We've gained new listings in Aldi and Little as well. And again, we've managed to work with both of those customers, and it's decently profitable business. We're not sort of doing silly business at razor thin margins. Holland & Barrett are a huge customer for us. We've improved our trading terms. We collaborate with them very closely on our joint business plan. And then the retail team have worked very hard, and contrary to, again, to public myth, we've managed to edge up our gross margin coming out of our retail business. In international, we were down 14% for the whole of the year. As you'd expect, places like the Middle East completely closed down due to COVID, Australia, etc., etc. Everything's bouncing back very strongly. We're having a very good month in March. January and February good. March is very good. We exited 60 small markets last year because we had quite a few subscale markets. Quite a few of them were legacy businesses from pre-acquisition. They weren't really making money. And like in most cases, you strip some complexity out of the business and actually you grow more, not grow less. That's exactly what's happening. We're extending PhD into key European markets. We've got a brand new international and very experienced sales director for international. He's opening up business for us in Germany and in Italy for PhD. And our long-standing relationship for science in sport with Shimano has now extended that business into Spain, and that's going very well too. And then finally, I've mentioned this the last presentation. The progress we've made on gross margin is structurally embedded in the business now. So it's not a blip. We think we can take 50 plus now as a benchmark and move forward. And that comes from buying, production efficiencies, cost savings. Again, a lot of focus on complexity reduction. We've taken out a lot of stock keeping units out of the business. We're doing a lot to reduce inventory right now. So simplify to grow faster. And then we've, second week of January, we signed a lease on a new 160,000 square foot supply chain facility in Blackburn. That the photograph there is of the one next door, and that's 130,000 square feet. So we've come up with something that's a bit bigger than that one. We take the keys to that on the 3rd of December this year. We'll be installing a new gel line January of next year, and around about this time next year that the whole thing will be up and running. We would expect that to bring benefits to gross margin during next year through reduced logistics costs. And then later next year, we're going to install new bar lines, new tableting lines. And then over a couple of year period, we can directionally see gross margins start to move towards the mid-50s. Now, you've got to remember where our gross margin currently stands is the best gross margin in the industry in the world, full stop, as a matter of fact. So we're already a gross margin leader. And if we can improve it more, that gives us a real strategic edge over the competition. So that's a walk around the flywheel. James is going to walk you through ESG and through the numbers, and then we'll come back and wrap up with the outlook for the year. James?
Right. Thank you, Stephen. So ESG stands for our environment, society and governance initiatives. It's an increasingly important focus for consumers and a growing consideration for investors. We see SIS as very well positioned from an ESG point of view. We support our customers' well-being and health, both key considerations during the COVID pandemic, and we're doing this in an increasingly environmentally positive way. We launched the first recyclable pouch in the industry. You heard Stephen say that's going to save around 1 million pouches going to landfill this year. In the picture there on the right, you can see Ross Edgley, our ambassador. He's got a new free post bag customers are using to return gel, bar and sachet wrappers, meaning we've got recyclability across our product range. To support our employees during the difficult lockdown, we launched wellbeing initiatives with employee assistance programs available, online one-to-one counselling and wellbeing sessions where we've had experts such as Sir Chris Hoy come in and talk to colleagues. Our business-wide diversity and inclusiveness initiatives include a wide range of things. Some of the ones I'll call out are the Race at Work Charter that we've signed up to, plus a wide range of activities, including sponsoring the Black Cyclist Network, running an anti-racism and cycling webinar series, and sponsoring the Los Angeles Bike Academy. We've got career-ready mentors in place at the moment. This gives disadvantaged students an opportunity to see what it's really like working in business, picking up some transferable skills with some of our colleagues. And finally, something I'm really excited about, we're doing a carbon-wide audit across the business at the moment as a first step to exploring how we can become a carbon neutral group. Moving on a couple of slides to financials. As you heard on the highlight slide, we held sales level at 50 million in 2020, despite the adverse impacts of COVID lockdowns across all our markets. While holding sales level, we grew gross profit 2.4 million to 24.6 million, an 11% increase and a nearly 5 percentage point increase. We did that whilst maintaining marketing investment at around 8 million in the year, with carriage and selling costs increasing as sales migrated towards higher gross margin online channel in line with our strategy. We were tough on administrative costs. We got those down 5% through a tight focus on cost control. However, we did sustain and in some areas even increase investment in what we call growth overheads that support our top line in areas such as online trading employees, technology, and product innovation. As a result of all this, underlying EBITDA was 1.1 million, up 1.3 million on 2019, demonstrating the profitable growth model we put in place during the year, and all this after absorbing around 0.3 million of COVID-related costs. On the next page, you can see the trading contribution, the brand margin, broken down for SIS and PhD. You can see that sales for both brands were broadly flat, with improved gross profit margin and gross profit value in line with the overall group performance. We moved some marketing investment towards PhD to drive the strong database we called out earlier in the digital slide as we build online scale for that brand. Trading contribution for both brands stands at around 20%. That's a really healthy profit flow through and increasing year on year at a group level. Moving on to the next slide, we see here how we've generated cash during the year. We started the year with 5.4 million cash and brought in 1.1 million from operations. You'll notice that's broadly in line with the underlying EBITDA profit measure we use to measure performance. Disciplined working capital management and the channel shift towards online generated a further 2 million of cash, which effectively funded all of our capital investment requirements for the year. We raised 4.2 million cash proactively back in April to provide further liquidity during the COVID pandemic, and also more excitingly to invest in revenue growth opportunities as lockdown restrictions start to ease. Also included in that number is a small amount of equipment leasing payments as well. As a result, we ended 2020 with 10.5 million cash, in addition to an unused 8 million flexible credit facility agreed with HSBC, our principal lender. This gives us a really strong balance sheet platform to drive further organic growth this year. I'll hand back to Stephen now and on to the final outlook section.
Thanks, James. So I can see quite a few questions clocking up now. So let me just finish with this. Let me just finish with what we feel about 2021. The summary is we're feeling incredibly positive. We weathered COVID well. We got some real momentum in Q4. We hit record numbers in November, and we got some real momentum. And you can see we've carried that into Q1 to perform like we're performing during lockdown. Says a lot about the health of the business. So we think the sun's shining. We're getting vaccinated. People are starting to train for events. Some events are being announced as being on again now. So we think everyone's getting optimistic. We're seeing that in the consumer numbers. So we think we've got through Q1 exactly where we wanted to be, bang on game plan. And so now when Q2 comes, we think we're going to hammer it hard and then try and get ahead. So we're very bullish. Gross margin improvements are flowing through already, and we'll keep pushing on there. We've got an outstanding supply chain team in Nelson who just keep optimizing that unit more and more. And again, with this shift to online, that's obviously improving gross margin in its own right. More investment in technology, we can see the benefits. In fact, I'll not say it too much more about the benefits because somebody's asked me a question on that. And then phase 3 online markets are growing. Japan launches tomorrow, South Korea launches in a couple of weeks. You're going to see new sites launch around Europe during the coming weeks and months. So our phase 3 wave of international launches is about to start. It's worth noting that we built all the costs for those launches into our business plan for this year, but we didn't build that any revenue in. So if we do get some decent traction in one or more markets, that can certainly help our growth performance for the year. So we believe we've got a proven strategy. There's no doubt. The same strategy grew SIS from 5 million through to its current level. The same strategy is working very well on PhD. So we think we've got a proven growth strategy, which is now driving a very profitable growth story. So fingers crossed there. Let's hope we don't have a lockdown but we're feeling confident as a management team. Everything's fallen into place. We think we've got the strategy. So let's see how we go. We'll report back. We'll report back at the half year. We've got a pre-close update in the first week of July. We'll come back here and do a presentation again then. So thank you for your time.
Fantastic. Thank you very much, Stephen. Thank you, James, for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you will be redirected for the opportunity to provide feedback in order the company can better understand your views and expectations. Stephen, James, we've had, as you can see, a number of questions submitted by investors during today's presentation. Perhaps if I could just hand back to you to respond to those where it's appropriate to do so, and may I ask you just to read out the question and even who it's from. That'd be fantastic. Thank you.
Okay, yeah, we've got some great questions here. So let me dive straight in. So I've got a question from Alex that asks how we will leverage the investment in the customer data platform to strengthen marketing ROI. Answer it in two halves. I mean, through our new team, our new performance marketing team and new trading teams, using some of the tools we've got in place prior to customer data platform. So some of the Adobe tools we're using on Magento, we're able to target things like social and SEO ROI much more acutely. The new team that have come in have changed. We've changed the agencies that support us. So our SEO agencies, our influencer agencies. So in general, at an overall level, we're seeing a better return on investment in our digital marketing. The customer data platform, to be brutally honest, I mean, up until this point, we've largely sort of put together in meeting rooms by looking at a bit of rough data who we think our customer is. We've now got a customer data platform which will enable us to know a lot more about the close to 1 million people on our database, and it will enable us when somebody new comes to the platform to tell us where they've shopped before, what other kind of products they buy. So the answer is, because we'll be able to segment our database and our traffic into hundreds and hundreds of segments, we'll be able to very much more pinpoint target them with the right product, the right promotion, the right offer. So we in general, marketing ROI is well up on last year. We think in the second half, CDP will drive it up more. Pierre, will be great to get an update on traction to penetrate football. What's your view on your ability to make science in sport as close as relevant in football and cycling? It's a really good question. Our football business at a retail level is relatively small, so a bit over £1 million, but very profitable. And we think we can start to move that up in big steps. In fact, I believe somebody promised me he would double it this year. But we don't mind that relatively small scale, because what's happening in the background is exactly what Pierre asked. We are now advising and or supplying probably about 110 of the world's top football teams on all continents. So everyone knows that we're the official partner of Manchester United. But if I can think of the most recent teams the guys have been talking to me about, last week they were in conversation with Real Madrid. I know that they work with the team at Barcelona designing products. I know the guys have been working with Bayern. So we can really say that around the world we're working with all the top teams now. And that recognition over time trickles down to the consumer. And that's exactly what happened with SIS. We started out helping Chris Boardman get his first Olympic medal, a young Mark Cavendish, a young Bradley Wiggins, when they were literally schoolboys. And then that gradually trickled down, and now SIS is the dominant player in global cycling. So we think football's a patient game. It's definitely a profitable game, and the scale will come with credibility. Andrew asks me, could I say more about the products to aid cognition and sleep mentioned earlier? Sounds very interesting. Our product innovation team do a lot of work with elite athletes on things like sleep, inflammation, recovery while they're traveling. So, for example, the guys develop sleep products to help them. Over a period, there's been work done on things like mental acuity in athletes, and it's from things as basic as caffeine all the way through to sort of new generation nootropics. So we've done a lot of background work, and we think there's real scientific data behind it, rather than just sort of bulletin board sort of weeds and seeds chat. When we look at the PhD brand, we think that the PhD brand, which is around active lifestyle, is well set to carry a lifestyle, cognition, sleep, nootropics range. The guys went and researched that. We got a very positive response. So I said earlier about the PhD user being more open to innovation, spends a bit more, tries a few more new products. The research on this range tells us that will be the case. So we'll launch it probably late May. And we think it will be a nice, we think it'll give us a nice high margin layer on top of our hardcore PhD revenue stream. David is asking me, is there a possibility that selling products in Aldi and Little dilutes your premium brand image? It's a great question. I think there's a guy on this call, namely me, who once said, we're selling in Aldi over my dead body. I'm not destroying the brand. And actually, I was 100% wrong. When you talk to the consumer, the quite high earning bracket see themselves as very smart shopping in Aldi and Lidl. So it doesn't really dilute premium brand. You're selling to a high income group. There's nothing in our numbers or in any of our feedback suggests that it's diluting brand. But good for you, David, because she asked the same awkward question that I asked and was, shown the door with. The marketing guys showed me the door with it. Brian, the retail markets that have been exited, are they being replaced with your own digital? The international retail markets that have been exited, yes, 100%. So wherever we've exited a retail market, there is an online solution, usually Amazon, and sometimes some of the new websites we're putting up. So we don't believe that by exiting these markets we're losing any volume, rather the opposite. How are orders being fulfilled for international online offerings? A lot of it's serviced out the UK and serviced on very sound economics. So it's not a profit drag. We do have a third-party logistics unit in Melbourne, We've got one in northern Italy, and we've got one in Chicago. So we do have third-party logistics companies. So we've got a mix of fulfilling from our own factory and from 3PLs. And it works pretty well. Brian's got a few questions. So for everyone out there, Brian's got a few questions. Let me finish them off. Are there any issues with Brexit? Yeah, we're dealing with them, and any downsides built into the current performance. So it's not in general dragging down performance. There's a lot of problem getting products into Europe right now, and that's mainly because the national authorities, whether they be Brits, Italians, or Germans, appear to be making the rules up on the spot. So it's slowed down the supply chain velocity a bit. It's taken a little bit of the top off the revenue in Italy and Germany, but not to a material degree. And so I just look at it as upside. Our very hard-working compliance and supply chain people are dealing with the issues. We've absorbed any costs related to it. So as we get those markets back on song, I just see that as upside. Is all production in-house? No, it's not. We do several bar ranges third party, and we do our effervescent tablets third party. The new shed that I showed you earlier will gradually absorb the bulk of that over the coming years, and that will be where some of the extra gross margin improvement comes from. Please outline the marketing strategy. This is Brian's final question. Please outline the marketing strategy, the objective return on investment metrics tracked, and how they've evolved. Really good question. We've moved over time from a very old-fashioned traditional media, adverts, buying space, even outdoor stuff that you commit to, very sort of lumpy fixed costs, to a very agile model. Big sponsorship deals, we're doing big sponsorship deals, so a lot of fixed costs. And this year, close to 70% of our investment is now directly in digital marketing. So it's almost variable cost. You can take it out at the drop of a hat. So we're very much digitally focused. Everything's driven on very tight return on investment metrics, and indeed the first 5 tabs of my browser bar are actually marketing metrics which update every 2 hours, and indeed the live trading teams can react even quicker than that. So it's a digital marketing strategy. We've got very clear and challenging return on investments for every single digital channel we're marketing in, and they're tracked live time, really. I can see them every 2 hours. The trading people see them all the time. So we've gone from old world to new world. Joseph asks, with such a strong net cash position and with operating cash flow now positive, are you considering further acquisitions or strategic investments? Yeah, good question. Never say never to another acquisition. I think COVID's really shaking out the market globally. We've had a number of smaller brands put up the white flag and ask if we'd be interested. I think we're at the size of the business. We think we can organically double it pretty quickly. So we really don't want the distraction of a small acquisition, because the small acquisition is as complex as a big one. It may be down the road. There are 2 or 3 brands around the world that will be significant and could double the size of the business again. So never say never, but it's not going to be in the next 2 or 3 years. And when we do one, it would have to be substantial, or else we're just wasting our time. At the rate we can grow our business organically, you'd have to pick an acquisition very, very carefully for it to produce a better return on investment that we're getting from the organic growth of the core business. Paul, when and how do you plan to become profitable? We've had a very clear growth strategy. That's been agreed with our investors and are evolving the investor register along the way. You can see that we've moved into profit at an EBITDA level now, and that we're now generating positive cash. We don't see ourselves becoming profitable at a statutory level for maybe 3 more years. And the reason for that is we're still a growth story. First and foremost, this is a growth business. We don't want to be a highly profitable £50 million minnow. We want to be a 100 million business and a 200 million business, throwing off 10 or 12% EBITDA. And so we're going to keep investing in growth. So we're not averse to profit, but we think growth and scale comes before hitting a PBT target. And that's been the plan all along. So if I said 3 years from now, roughly, but the business will be a lot bigger. And then Boris has asked me the same question: how long to reach 100 million and double-digit EBITDA? You can look at the modelling now. Liberum have got an opinion in the market. You can look at the shape of the business now. This business is around about 100 million. The investment line's steady. You can see gross margin creeping up. You can see how we're leveraging overhead. You can do your own maths. 100 million revenue would see us around maybe 10, maybe 12%. That's just straight mathematics. That's not me giving you some kind of inside forecast. You can just do the maths there. 100 million depends on when lockdown ends. You know that for 6 years we grew science in sports at 25%. You know that in our first year of owning PhD, we improved growth from 7 to 23%. So once we get the other side of COVID, we think we can return to those sorts of levels. Who knows? I mean, if some of these new markets come off in a big way, maybe we can do a little better. But again, you can do your mathematics on that one. So the answer is as soon as possible. Let's get past COVID and crack on. What's the place of retail? Retail's got a very clear place for me. I can always see a place where the retail business is 25%, maybe 30% of the overall. The reason being, retail gives us brand awareness, retail gives us trial, but most of all, retail is hellishly profitable. We've got a very good, experienced retail team on all our markets. They're convinced they can grow the business. I believe them, and I'll believe anyone who can grow a business that kicks off the type of cash that our retail business kicks off. So always we will have a retail business. And can you prove the superiority of your science in sport products? Yes, we can. You will find we've got a very talented sports science team. They're regarded as one of the most talented teams in the world. We recently announced our scientific advisory panel, which is made up of 6 of the preeminent sports scientists in the world. All the products in our range have got scientific support. And in fact, if you work through our website and pick products out, you'll see down in the product details, there will be scientific references. So we've got real edges in things like isotonic gels, in energy usage, in recovery, and that's expanding. It's a bit of an iceberg. What the consumer sees with regard to our scientific knowledge and claims is only the tip of the iceberg. There's a hell of a lot more in the background. It's measurable. There's no other endurance nutrition business in the world doing as much on sports science as we are. And that would be about it. Oh yeah, Michael, we talked about the positioning as regards brand awareness. Can you give details as regards market share? To be honest, we don't really play that game, and that's not me being evasive at all. I think the issue, and it's a positive issue, is the blurring between hardcore sports nutrition and healthy snacking now is so blurred. So you can ask one analyst to tell me the size of the sports nutrition market, and they'll tell me a number, and the other one could give me a number twice as big. So safe to say we've got strongly growing brands in the market, whichever way you define it. It's growing at 8. We're growing at least 3 times that kind of rate. So we don't play the share game simply because you can't define the playing field that you're on in real terms. And those are all the questions. So once again, thanks for the questions, and thanks for your attention, and thanks to all for such a healthy audience turning out today. And we'll be back in very early July to update you on trading for the first half year. Thank you very much.
Stephen, thank you very much for addressing all of those questions you have done from investors. And any further questions are submitted, obviously the team can review those. Stephen, I was going to ask you for a final few words, but I think you've pretty much given them, unless there's anything further you'd like to add.
Not a sausage, no, thank you. Thanks.
That's what I thought. Look, thank you very much indeed. Thank you for updating investors today. Could I please ask investors not to close the session, as you now automatically be redirected for the opportunity to provide your feedback. If you've accessed the meeting from our website, the feedback page will appear. But if you've accessed the meeting via the link sent you in an email, you'll simply be asked just to log back in to give your feedback, and please take a couple of minutes to do so, because it's much appreciated by the company. On behalf of the management team of Science and Sport, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you very much, and very good afternoon to you all.